A significant structural transformation is quietly reshaping Nigeria's petroleum and economic landscape, and unlike previous turning points, this shift is not driven by elections, protests, or foreign intervention. Instead, it is emerging through the fuel market, altering long-standing dynamics around pricing, supply, and Nigeria's dependence on the United States dollar. At the center of this change is the Dangote Petroleum Refinery in Lekki, Lagos State, whose operations are beginning to redefine how fuel is produced, priced, and financed in Africa's largest oil-producing nation. For decades, the US dollar exerted considerable influence over Nigeria's economy, largely without direct political intervention. Its power was rooted in necessity. Fuel prices, transportation costs, food inflation, and household purchasing power were all indirectly tied to access to foreign exchange. Nigeria's recurring fuel crises followed a predictable pattern. Despite being a leading crude oil exporter, the country lacked sufficient domestic refinery capacity. Nigeria exported crude oil and imported refined petroleum products, including petrol, diesel, and aviation fuel. Every imported liter was paid for in US dollars. At its peak, Nigeria spent an estimated $20 to $25 billion annually on fuel imports, drawing heavily on oil revenues and foreign reserves. This persistent outflow placed pressure on the naira, weakened the currency, and fueled inflation. Transport costs rose, food prices increased, and the real value of wages declined. Debates over fuel subsidies were therefore never just about pump prices. They were intrinsically linked to the country's capacity to manage dollar demand. This long-standing structure is now facing its most substantial challenge with the gradual ramp-up of the Dangote Petroleum Refinery in Lekki, Lagos State. With an installed capacity of approximately 650,000 barrels per day, it is the largest single-train refinery in the world. Analysts note that smaller facilities would not meaningfully alter Nigeria's reliance on imported fuel. The refinery was designed to replace imports and meet domestic demand at scale, rather than merely complement existing supply channels. As production increased through 2024 and 2025, the effects became evident. The refinery began producing an estimated 45 million liters of petrol and 25 million liters of diesel daily, totaling nearly 70 million liters of refined products per day. This output approaches and in some estimates exceeds Nigeria's average daily fuel consumption. For the first time in decades, domestic production has the potential to cover national demand. Each liter refined locally reduces the need for imports and the corresponding demand for US dollars. This shift directly eases pressure on the foreign exchange market, benefiting banks, fuel marketers, and the Central Bank of Nigeria. Market data began to reflect these changes. In the first 9 months of 2025, Nigeria reportedly spent about $1.25 billion on fuel imports, approximately $5 million per day. As local refining expanded and imports declined, the pace of dollar outflows slowed. By late 2025, Nigeria's external reserves had risen to roughly $46.7 billion, the highest level in nearly 7 years, up from just over $40 billion earlier in the year. Analysts attribute this improvement largely to reduced fuel import bills, signaling a structural adjustment rather than a temporary reprieve. The implications for currency stability are considerable. Reduced dollar demand from fuel imports lowers volatility in the foreign exchange market and eases pressure on the naira. While it does not guarantee immediate currency appreciation, it reduces the frequency and intensity of dollar shortages that have historically driven inflation. Economists describe this as a foundational change in how Nigeria uses foreign exchange, one that alters the balance between imports, reserves, and domestic production. The refinery also creates opportunities beyond import substitution. Once domestic demand is met, Dangote Petroleum is positioned to export refined petroleum products to regional markets. West and Central African countries collectively import substantial volumes of petrol and diesel each year, often from Europe, the Middle East, and Asia, due to insufficient refining capacity. Nigeria's geographic advantage and production scale offer the potential to supply these markets. Exporting refined fuel transforms Nigeria's historical role from crude exporter and refined product importer to a net supplier of finished products, reversing the traditional foreign exchange outflow and positioning the country as a regional energy leader. Domestically, the impact has been immediate. In December, the refinery reduced its ex-depot price of petrol, triggering competitive adjustments across Lagos and other key markets. Filling stations implemented lower pump prices, providing relief to motorists. Private depot owners and the Nigerian National Petroleum Company also adjusted prices in response. Analysts note that both importers and local producers absorbed short-term revenue losses, reflecting the intensity of this market realignment. These developments have not been without controversy. Regulatory tensions, debates over import licenses, and concerns about pricing sustainability have intensified. Some industry observers caution that aggressive underpricing to gain market share may not be viable long-term, while others argue that short-term disruptions are necessary to dismantle a system that entrenched import dependence and currency vulnerability. Policy decisions now carry heightened importance. Analysts warn that if fuel imports regain preferential access through waivers or inconsistent regulation, dollar demand could rise again, potentially reversing recent gains. The broader African context further underscores the significance of this shift. Many African economies face a similar structure, exporting raw materials while importing finished goods paid for in foreign currency. This pattern exerts continuous pressure on local currencies and reserves. The Dangote Refinery demonstrates an alternative, refining locally, meeting domestic demand, and exporting value-added products. Economists note that the same principle could apply to other critical sectors, including food processing, fertilizers, cement, steel, and pharmaceuticals. What is unfolding, therefore, is more than a story about fuel pricing or a single industrial project. It represents a test of whether Nigeria can fundamentally alter a system that linked essential goods to foreign currency dependence. Currency dominance is sustained by necessity. As the demand for dollars in critical sectors declines, so too does their influence. For millions of Nigerians grappling with high living costs and fuel-driven inflation, the outcome of this transition carries profound implications for household budgets, economic stability, and Nigeria's long-term position in regional energy markets.